All of that said, my next guest thinks the central bank will hike rates a half point at its next meeting. Then what? Let's bring in Rob Dent. He's the senior U.S. economist at Nomura. I mean, I think, what do we call him? A Fed member Barkin's comments are wise. Rob, I mean, it's a lot to read into just a few weeks of quote unquote better inflation data.
Yeah, Kelly, thanks for having me on. I mean, I would completely agree. I think at this point, we at Nomura would probably encourage market participants to not miss the forest for the trees on the recent inflation data. Yes, a number of indicators came in a little bit better than expected this week. You highlighted CPI and PPI in particular, but I think there are a number of structural factors that are still going to be pushing up prices over the next 6 to 12 months, wage growth being a big one. There's still a lot of concern about inflation expectations. And that 1970s period, I think, is weighing on the Fed in terms of their thinking for the outlook. At that time, they backed off maybe a little bit too early. Inflation became even more entrenched, and they ended up having to do more than they originally planned. And so I think that example is quite relevant for where the Fed finds itself today and backs up our expectation that, they may slow down in September by delivering a 50 basis point hike after 275s, but there's still a lot of work ahead for them, which probably means an additional series of rate increases, holding them at a very restrictive level, even as activity continues to soften. What
do you guys make of all the kind of recession talk? Or, I mean, it's abated somewhat obviously lately, but the yield curves, 3-month 10 years getting pretty close this week to inverting.
Look, we still think that we're heading for a recession as early as Q4 of 2022 this year. I think if you look at a broad range of economic indicators across real consumer spending, the housing market, business confidence, business investment, all of those are continuing to weaken over the past couple of months. That's consistent with this slowdown that we're expecting as the Fed continues to tighten policy to bring inflation under control. Now, of course, NFP last Friday was stronger than expected. I think that made the market a little bit more comfortable that maybe we can achieve a soft landing. But at this point, we don't think NFP is the best indicator for where growth momentum is, considering how much of a contribution growth in sensitive industries like healthcare and education are contributing at this point. Another really big problem facing the Fed is that financial conditions have actually eased since June. I think they're going to have to lean even more against that, which should mean even more of a slowdown over the next couple of months.
That's amazing. A couple of things to highlight there is, number one, it's not like your recession call makes you think the Fed should back off here. You're saying it's almost not that relevant. And number two, when you look at financial conditions easing, what are you looking at in particular? Is it the drop in interest rates that we've seen?
So I would say we still think the Fed is effectively a single mandate central bank focusing almost exclusively on inflation. You've seen that come through in the comments from Evans and Kashkari earlier this week after the July CPI report. You heard that from Daly last night, and certainly I think from Barkin today. And so what we think that means is we could go into a recession, but the Fed is going to continue to keep raising rates until inflation comes down more meaningfully, because the risk is that inflation becomes much more entrenched, and ultimately the downturn that they face could be much deeper in that situation. Now, in terms of financial conditions, our financial conditions index at Nomura tracks a couple of different things. We like to look a lot at credit spreads. We also like to look quite a bit at the equity market and at interest rates more broadly. Our index right now suggests that financial conditions are boosting growth by about 3 full percentage points.
Wow.
After being effectively neutral in June. And so I think there's still a lot of work for the Fed to do in that regard.
So, I mean, this is so complicated because if I hear that, I think, well, then they should do another 75, maybe a full point hike. I don't know. I don't know if that just all sounds too crazy.
I think the main message for the Fed at this point needs to be, we're not going to back down as activity softens. There is really no dovish pivot at this point. We're going to continue raising rates and hold them higher for longer if we need to make sure inflation moderates. From their point of view, they've done a series of very, very large rate hikes. Those are still going to affect the economy with a bit of a lag. And so maybe they can slow down a little bit as they start going deeper into restrictive territory. But I think the message needs to be, rates are going to be high for a pretty long time. I think that's something that's relevant when many speakers continue to point to the dot plot from the June meeting, which shows continued rate increases in 2023, pushing back against this notion that the Fed is going to quickly cut rates next year.
Right, exactly. I was going to say it doesn't sound like you're in that camp. So one final question, Rob, that really gets to the heart of all of this and that lag you were talking about. What does winning on inflation look like to the Fed? The CPI data are going to show their moves with an extreme lag, as we've seen. You could call it up to 18 months, right, based on the pandemic response. So are we really to expect that in any of the coming months that they would either, see CPI readings or PCE readings flatten out to just a tenth or two, or respond to even if we got 2 or 3 months of them? I assume they'd want to see maybe 6 months of those kinds of readings to feel comfortable.
Yeah, we do think it's going to take multiple months of data, at least 3 to 4 months of core PCE inflation on a month-over-month basis, coming in around 2.5 to 3% annualized. That's much closer to their target. I think at that point, if they see that, which we expect around the first quarter of next year, they can stop hiking rates at that point. We think the last rate hike is going to be 25 basis points in February. That would lift the target range to 3.5 to 3.75%. Which is pretty elevated by historical standards. But it's really going to come down to actual inflation. We think the month-over-month numbers are the most important at this point. We do not think the Fed can afford to operate on expectations or their forecasts of inflation, just because forecasting inflation right now has become incredibly difficult.
Yeah.
And so it's really going to come down to realized data.
No, it's, Rob, thanks so much for, we appreciate it. A look at many of these different inputs. It can sometimes feel contradictory. Thanks for all your time today.
Shepard Smith here. Thanks for watching CNBC on YouTube.